Stocks finished mixed on Thursday, but don't let the surface fool you. Today's market was all about a split sentiment there. On one side, Oracle really moved higher after its earnings today, over 13%. So it kind of led the very narrow AI segment of technology who did pretty well in big tech, mega cap tech. But underneath that surface, defensive sectors led again as volatility jumped. Bond yields dropped lower today. Gold rallied. Bitcoin sold off. And the VIX jumped up 1.4%. So that's all kind of a risk-off mode, even with a little bit of gains in technology. So in today's Market Outlook video, we'll break down what this divergence means, why smart money may be starting to rotate a little bit defensively, and what that could signal for the road ahead. So let's go ahead and get started. Today is Thursday, June the 12th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Sell. Before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we created. All right, if you're on our Market Outlook blog post, you can check out some of those other things over here on the page. Maybe you can sign up for our newsletter over here with this form right at the top right. As you scroll down, you can see our video that you're watching right here. Now, again, remember on Monday, this will just be a preview video, about 5 minutes long. You'll be able to watch the full version by clicking on this link. Right now, this link takes you to the page where you can sign up for that, right? Sign up for our foundation tier, where you get not only our Market Outlook video, but also our Market Outlook live video, where I take it as a trade review. I do at 3:30 Eastern time every day. I review all the trades we've done, all the different Market Outlook videos. We manage them, whether we should stay in them or not. If you come down to the bottom, you can see it costs $29 a month for that, or less than $1.40 a video. Or you get 2 months free if you sign up for the yearly version of this. And if you do it before June 15th, so the end of the week here, there'll be a video on sector rotation that I'll send out to all of our initial members, founding members of this particular. This is a brand new tier that we just barely launched this week on MarketScholars.com. So this is the way that you can be able to see the full-length video starting again on Monday. I'm going to start off taking a look at the S&P 500 with the market forecast indicators. You can see we have a very strong intermediate posture. The intermediate line is up above the 90th percentile. We're still 3% above the moving average. So I mean, we had actually a 4.4% gain, thanks largely to gains in technology and these safety sectors you'll see here later. I mean, it was a pretty good day from that perspective, but the near-term line is still coming down. It actually broke 60, so technically this would be day one of it breaking 60. But on day one, the momentum line is actually higher than the near-term line. So this is not and again, unless something changes, this current setup is not pointing towards more near-term decline. In fact, you'd probably expect it will. I mean, I said yesterday that would probably bounce off of that low point, off of the drop that we had yesterday, and we did, right? So that's kind of the expectation there. And we're still, again, the market sentiment line's rising, the intermediate line's still above it. Everything is still fine. The near-term line's still, even if it's not in bullish territory, it's like within 1 percentile of bullish territory. Everything is actually looking really, really nice. And the momentum line jumped higher. It's not too extreme, so it didn't jump up too much, but we're continuing. We didn't get a new high today. We didn't get a new all-time high or 52-week high today. We're just grinding. It's a slow boring. It's the summer. It's June. It's a very boring time of year from a stock market perspective. And it's a boring time in the markets, considering how bullish this move has been for now multiple expiration sites. I mean, essentially this has been a 2 expiration set. We really started getting going the day after April expiration. So this has really been 2 options expiration cycles that we've been pretty bullish. The first one was really bullish, and the second one's been kind of bullish. But at least it's still bullish, and the intermediate line's still up in the reversal. So it hasn't been above the 90th percentile this entire expiration cycle practically. And market sentiment's gone from being just out of bearish territory to now being easily in bullish territory over the course of this particular expiration cycle. So things are still fine, and they're looking really good. And of course, that's how it looks like on the NASDAQ 100 as well. Intermediate posture strongly bullish, near-term line down, and below 60. So day one, they're dropping below 60. The momentum line is below the near-term line here, but it's not oversold, right? So it's not a threat. Like, we're not threatened to have a very bearish move. As you can see, we're still on the same near-term rally over the course of the past few weeks. And if I take a look at the Dow Jones Industrial Average, which is also up 0.25%, looks very similar. The near-term line is not below 60, but it never did get above 80, so it's still kind of wishy-washy there. It's in bullish territory, but not really very strong. Never did really get that strong. And the intermediate posture, though, is rising above the 95th percentile, so that's pretty strong. And then your market sentiment line is just a hair short of the 60th percentile, so it's really, really close to joining bullish territory as well. So again, nice, good bullish trend going here on the Dow. The Russell 2000, a little different story. So it was actually down today. It was down yesterday. Remember, yesterday it did drop below 60 yesterday, barely, and it had an extreme low on the momentum line. The momentum line did jump out of the reversal zone, but not, barely, only because we were just a little bit off the lows. I mean, we were down 0.4% again. The near-term line is in bearish territory, clearly in bearish territory. And, yesterday was a buy the dip signal, a bullish intermediate confirmation signal. It wasn't ideal because your momentum line was too low and your near-term line wasn't low enough, right? So it's not the most ideal signal. But by definition, it was, and this technically would not be a bullish confirmation signal. But, if you put the momentum line being below the 20th percentile yesterday and the near-term line now finally getting into bearish territory today, but not too oversold, then you can kind of look at this as, kind of a 2-day bullish intermediate confirmation signal, and you have an opportunity for a bounce up tomorrow on the Russell 2000. So a little bit of a risk off the last couple of days. But this may be short-lived, right, according at least to the market, to the strong trends in the large cap indexes and a short-term bounce opportunity on the small cap index here. Let's take a look at the long-term chart. If you notice, again, we have a strong weekly candle. Remember, we need to be trading above the close of the body of the Heikin-Ashi body, and we are. We're 20 points above that at 60.45. Pretty much all of today's gain got us up there. So that sets us up for a good move, for a good candle for next week, right? It might not be a big body. It might not be as big as this one, and this one's not that big either. As you can see, it's relatively big considering. I mean, there's been bigger, but it's in it's pretty high. It's a pretty decent size for a bullish candle. So it might not be as big next week, but at least it will be bullish if we continue to trade by the end of tomorrow, because we got one more day of the week, above the Heikin-Ashi close. So we're looking pretty good there. 3 green arrow charts. We obviously do not have 3 green arrows, but at least the MACD histogram did turn closer to zero. It's barely away from zero. The NASDAQ 100 actually did not. It continued a little bit lower. Your 3 green arrows on the NASDAQ is susceptible to in the Russell 2000, is susceptible to a drop here on the history. You can see the histogram has been dropping and is getting close to zero there. And then, of course, you have a really, really flat and small. I mean, there's no momentum. If you look at the histograms and all these, I mean, there is literally right now no momentum in the markets at all. But that's normal. When you're strongly bullish, it's normal because you don't. The potential reward to risk ratio right now is not very high. Because when you're coming off of a low point, then your risk is below the low point. The further away you get from that low point, in this case an intermediate run, then the bigger the risk can be now, and the lesser the reward. So when you don't have as good of a reward risk ratio, then you just stop going. But you don't have a reason to sell either. Then you just stop going up as much. But at least you're still grinding higher, and you just lose momentum here. If you look at the DMI. The directional movement index, again, it's not looking too great. The ADX is rising, but because that negative indicator is really dropping pretty fast. But we can't get above 30 on the positive, so we really can't get going at all on the directional movement index. At least we still have bullish indicators here. You are below 100 on the CCI, but at least in the upper half of the chart still. and you're easily below 60, above 60, excuse me, on the RSI. So we're still looking bullish there. The Ichimoku cloud and the trend strength indicator is still very strong and bullish, mature trend. The rate of change is clearly positive. It's falling, but as you can see, the red line, this red line is graphed on the rate of change chart here. So I mean, it's falling, but it's, last few days it's been rising pretty nicely. So that's a good sign. If I look at the Bollinger Bands and the Keltner channels, again, we are trading right up against that upper band. The bandwidth is really small, and the bandwidth I guess we're kind of barely above the upper Keltner channel too. But we did get the Bollinger Bands outside of the Keltner channels. We got the green dot down there and an increase in momentum as well, as the momentum bars have turned up with the lighter shade of blue there. So these are all good signs for the markets. Again, it doesn't mean that we're going to take off for 10% in a couple of weeks, but it does mean that we're not going to drop 5% in a couple of weeks either, most likely. I mean, again, barring a change, barring some catalyst that would change the sentiment. But right now, the sentiment is so strongly bullish that it's hard to get any kind of bearishness, right? Because any kind of bearishness is quickly, most of the time, bought up overnight. But even during the day, it's bought up pretty quickly. If I take a look at today's intraday range, again, we did not get a new high, but we're still, we're just a day off on the Arun indicator. We're still pretty tight on the range, and we're not going to move up though on the low anytime soon. So we're still fine there, at the top end of this range above the value area. So we're still, looking pretty good. The range is small compared to the average. The volume also was relatively light. So we continue to move towards 1% very quickly. We've gone from 2% down to almost 1% very, very quickly. If you notice, if I were to go out to the last time we were above 2%, over here, we didn't get below 1% for a very long time, right? By the time we crossed below 2% here in November 2022, we didn't cross below 1% until June of 2023. So we were like 7 months away there. Over here, we crossed below 2 in the middle of May, and we're just now to the middle of June. And we're not below 1 yet, but we're getting close. So that's a pretty rapid change in sentiment there. It kind of goes to show, it's kind of like July of 2020 when we dropped below 2%. We made it all the way to below 1 when we went parabolic, but then that led into a intermediate decline there that, we got saved by the election results and the vaccine results there in November, early November of 2020. So that's, it's not very common for us to drop this far, this fast on that ATR, which is, remember, is a measure of kind of how volatile things are right now. And then finally, when you look at the VIX, which does directly measure volatility, the VIX is up today 4.5%, up above 18. You can see it was above the 85% mark relative to the VIX 3M, the 3-month VIX. VIX, remember, is not for 90 days. The VIX 3M is for 3 months. So it's a comparison of a kind of a shorter term VIX to a longer term volatility index. We're still we're still in risk on. This is below 90% is risk on, above 95% risk off. So we're still easily in risk on mode. But this is kind of the concerning thing. The VVIX jumped up to 103. So the VVIX, was flirting with breaking below 90, and then all of a sudden has jumped in 2 days up to 103, and it's made the correlation with the VIX drop like a rock. Yeah, it's still positive, but it's well below the 50% mark. Again, you can see it's not very common for it to be this low, at least not lately. It was common before, but not lately, right? We've been in this mode, and usually when we drop below this 50% mark, it usually leads to some increase in volatility. Because again, the VIX is running up a lot more and a lot faster than the VVIX, is running up a lot more and a lot faster than the regular VIX is. That's usually telling, as it's kind of foreboding that something may be coming up here. Again, I'm not talking like a move up into the 50s, but a move up into the 20s is very reasonable opportunity here. As like right now, when you look at where that VIX is, especially relative to its own average values, there's like all these averages are below the 200-day. We've been below the 200-day for so long that all these lines are getting below there. But can we move up to 25? Sure, right? And that's what that divergence between the VIX and the VIX may be telling us right now. All right, let's start off taking a look at our asset class comparison chart. As you can see, this is kind of a risk-off day with gold and bonds leading the way higher. Developed markets did pretty well, with the rest of the stock market kind of very flat. The small cap, of course, being the only equity market that was negative, but the dollar was down. And we talked about this. I was on a space yesterday morning with JC Pretz, big technical analysis guy. Stock Market TV, I think, is the name of his site, or the Twitter account that hosted that space. It's a video space, so I think your live streams on YouTube as well. But we talked about the dollar quite a bit. And I brought up this idea that the dollar's been consolidating and ready to move, but break out, but doesn't necessarily mean a breakout to the upside, right? Like we saw over here that we had a big momentum. So you can see when the MACD drops, you have big spaces between these moving averages, and then the spaces get smaller and smaller as that MACD kind of moves up. Not breaking above zero, but just moving up as we converge, right? But then we reversed to the upside and really kind of took off into the beginning of the year. Well, here we did the same thing: big drop in momentum, big spaces in the moving averages, but then the spaces got smaller and smaller as we just converge on each other. But instead of a breakout to the upside, I talked about the idea that we might be breaking down to the downside, right? And you can see, that's kind of what appears to be going on here. Here's today's move breaking down to 97.85. So a relatively significant move on the dollar. So when you look at, that has its implications on equity, especially international equities. As you can see, developed markets doing well, and if the dollar's falling in a risk-on environment, then you expect U.S. stocks would lead the way higher because people are pouring their money into the assets at work, right? They might not be buying U.S. bonds because they're in a risk appetite environment, so they'd be buying U.S. stocks, right? Selling U.S. bonds has a bigger impact on the dollar than selling. There's a lot more money flowing into the U.S. From a bond perspective, more so than an equity perspective. And so, but there's also times in a risk-off situation where the dollar drops, which is not typical because the dollar is a safety trade. But if it drops in a risk-off environment, then international stocks do better. U.S. stocks are in a risk-off mode, and they might not be going up. Developed market, international stocks might not go higher, but they at least outperform. And you can see again, gold and bonds really making their way up. So, and gold continues just to be strongly bullish. It's not breaking out, like it's still up. We've already had our surge in momentum. The MACD's already peaked, so we're probably not going to get another peak. But in the histograms, also peak, and probably not going to get it. But without a turn down to the downside, you're probably not going to get another surge to the upside. We'd really be parabolic from that perspective, because if you look at the weekly version, we are parabolic on gold. When you look how big the gaps are here between these averages. So, and the PPO, this is PPO is normalized MACD, so you can look at it throughout history, and this is one of the strongest surges in gold that we've seen in the past 20 years at least. Not the strongest, but there's been others. But this has been pretty darn strong surge, and even if you look at it on a monthly basis, again you can see just how strong the PPO is. This is one of the strongest surges since GLD has been in circulation. If you go to the futures contract, which looks like it also, let's go back as far as it can go back. It goes back to the 70s, and you can see like over here in 06 going into 2011, there was a big time move in gold. You had some big surges along the way, and this kind of mirrors that level. Not quite as big as we saw in 75, 76 going into 1980, where gold just took off, but still, it's still a very strong run considering that we're on right now. So we're not breaking out to new momentum, but we are potentially moving like a little bit of an ascending triangle. We might start a little bit of a new intermediate rally out of this. So that would be a function of the dollar kind of weakening too, like continuing to weaken. As you can see, the intermediate line has crossed back above market sentiment. So I mean, we've been on an intermediate run for a long time. We did not have a pullback because the intermediate line didn't get into revert. We didn't get dark pink shading in the red lines. We didn't get a pullback. We're still on this intermediate run that we've been on for a while. But it doesn't, it doesn't mean we can't go up for a period of time. And then the other safety trade is long-term bonds. So it got a bear tag today, and bear tags can either be a drop to the downside, so a continuation of this bearish trend, or a reversal, right? Because reversals start with bear tags. You can see this short-lived bullish trend started with a bear tag, and if you look at like other bullish trends that we have, they pretty much all start with a bear tag. That one started with a bear tag. This one started with a bear tag. This one started with a bear tag. So they all start with bear tags. So we're getting a bear tag on TLT today. It's good, strong near-term posture. We're well above the moving average at the 56th percentile. It'd be better if we were in the 60th percentile. So, but getting into the 60th would be a good thing. If you look at it on a yearly basis, we're not even above the 50. Well, let's see here. Let's try this again. We are above the 50. We're not above the 60th yet on the yearly basis. Again, getting above the 60 is kind of like your stochastic or even your market forecast. Getting above 60 is bullish territory there. So getting pretty close. But I would say that's a pretty strong bear tag that we're getting with some potential to move up. And if you look at the correlation right now between bonds and gold, so here's bonds, and then let's pull up gold on the other hand. So kind of like two very common safety trades, right? So let's pull up gold here. They don't always go up together. You can see their correlation, especially, let's move it to a 3-month correlation so we can kind of take a look at a bigger picture. You can see they don't always move together. They've recently been pretty negatively correlated, but now, as I go back to the 10-day cycle here, now they are starting to move together, getting back to a positive. And you can see we are emerging, it's not necessarily we're breaking out today, but we're moving into a period where bonds typically do very, very well through the rest of June and through all of July and August. And they don't do so well in September, October into early November. But this next summer cycle, this summer months, treasuries typically do pretty well. If I look at gold and see its correlation, you can see it's usually at the start of July, but July and August tend to be very strong months for gold too. And if they're positively correlated, they're both moving higher. Again, it's typically a scenario for risk aversion, not necessarily risk appetite. Breadth also took a drop today. Again, if you look at the Mag 7 stocks, because Oracle, right? Oracle had its earnings. We don't have Oracle on here anymore, but Oracle had its earnings today. So you had some mega cap names doing pretty positive. Broadcom, Nvidia, Microsoft, all doing pretty well here. And some others like Google and Apple did okay. Cisco did okay, but here's Oracle. If you look at Oracle, Oracle really jumping up to the upside. It had already been pretty bullish as it was, but a big time move on its earnings. So that's why you see like XLK doing pretty well, especially when the big three do pretty well. XLK was doing pretty well, but from a breadth standpoint, if you look at the McClellan oscillator, we pull back a little bit. We're still positive, but we pull back a little bit here. If you look at the number of stocks, those key numbers that we look at, right? The number of stocks above the 50-day moving average and the number of stocks above the 200-day moving average, and watching this ratio to jump up to the upside, hopefully because the 200-day index is rising. Well, it actually did rise today, but still hasn't broken that 300 level yet. But this one, the number of stocks above the 50-day, look at that. Like it's sitting right at 400. So it actually rose a little bit today too, sitting right at 400, and then the new highs and new lows index pulling back a little bit here. So again, the breadth is still positive, but it's we're not breaking out yet. And we may be at resistance levels on these breadth indicators. So It'll be interesting to see kind of how things trade as you see the sector rotation now. If I take a look at the sector rotation and look at it on a one just today alone, and I got this chart posted in the market forecast blog post. But you can see like we had a lot up today, but like XLK, XLY, and XLC, two mega cap sectors, were all down, right? Again, XLK, that's where Oracle was. It's where a lot of these mega cap names are. Nvidia, Broadcom, Microsoft, Apple are all in XLK. 1% gain, that's strong. But utilities are up 1.25%. And there's some idea. You could say, well, if everything's up, if all three of these sectors are up, then if utilities join them, that's an AI trade. But XLK seems to be the outlier in a bunch of defensive names. If I take a look at the rotation graph, the relative rotation graph, let's see if I can find it here. There it is. If I look at the relative rotation graph, and this is on a daily chart, you can see, look at all these trades kind of moving up to the right: energy, healthcare, material, real estate, staples, these utilities kind of trying to figure itself out. Like these are all sectors that typically, when they outperform, that's not correlated with strength in the markets. If you take a look at, energy's been having a pretty decent day, a week or so, but it's not correlated with the S&P 5. It's not positively correlated with the S&P, nor is it looking like it's looking like it's breaking, going up anymore. XLK is strongly positively correlated. This ratio chart is strongly positively correlated with risk appetite, but it's pretty overbought. The RSI is up as high as it is. The PPO is diverging. A lot of things like the CCI is diverging. We're at high levels that we've been at before. So we wonder, how much more does XLK have left in the tank here? Look at that run to get up to 52-week highs, essentially. Very, very strong move there. Again, on a relative basis, it's up above its 50-day moving average. You can see that there. That's what this line is telling us. That's good. It's all really, really good, and you can see well above the 817. But a relative strength after this surge of relative strength and getting a new kind of move in momentum. Again, we wonder can we build off of this? How much more can we build off of this? Looking at the weekly version of this chart. Again, you can see up to new 52-week highs, up to new all-time highs, kind of breaking out there and breaking above the 50-week moving average on the ratio chart, the momentum being as high as it is. But again, that's a pretty high level for momentum and rare for it to stay there. Right? So that means at some point in time, we're going to start losing some momentum in that space. And the other side of that coin, of that risk appetite coin, would be discretionary, and it's not looking the same as technology. And that's kind of what we would like to see, is discretionary reflecting the strength in the consumer, right? And in terms of risk appetite, because you need to have that positive sentiment from the consumer to be able to drive positive sentiment in the markets, and in this case in the stock markets as well. So for our trade idea of the day, I want to take a look in that technology space, and I want to take a look at applied materials. It's in the chip space, obviously. And you can see the intermediate, it's been pretty bullish too. It's been grinding up higher here. It's had a little bit of a pullback, but it got close to a bull tag, but didn't quite get there. And then we rebounded, right? Dark green shading, green line, and intermediate lines rising into the reversal zone again. Market sentiment rising in the upper half of the chart. So that's a good sign for this stock that's been down for most of the year. As you can see on the chart, a lot of dark pink shading and red line on this chart here. And obviously closer to the 52-week low than we are at the high. You can see that a really good week here from a Heikin-Ashi standpoint. In fact, the Heikin-Ashi close is now above the 40-week exponential moving average. That's our proxy for the 200-day. So that's a good sign for the stock. If you take a look at the 3 green arrows, obviously we've had 3 green arrows on the stock. We've had 3, we got 3 green arrows. We got the trend change way over here. We've had 3 green arrows ever since. So that's good. If I take a look here at the 2-line version of that chart, And obviously, we're breaking above the 200-day, but we're sitting right around the point of control. And again, the 200-day moving average as well. And we've already had a surge in momentum. So we're not going to, we're not getting another surge here because we didn't really have much of a pullback. So it looks like I'm not going to be too directional on this because of that. And you can see the ADX is still well below 20, even if your negative indicators finally falling back below 22 and your positive indicators above 30. If you look at your RSI and your CCI, your RSI and your CCI are kind of diverging as well here a little bit with lower highs, with slightly higher highs there on the index itself. The Ichimoku cloud is not looking too strong. I mean, it's a weak trend, kind of bordering on intermediate strength trend. We're above the cloud, but the rate of change is a week away from not being very strong unless we get a strong breakout here. If I look at the Bollinger Bands and the Keltner channels, the band width has come down considerably. You can see we're right there again at the point of control, right in the middle of the value area, flirting with the upper, some new momentum here and being above the upper Keltner channel, but not the strongest upside. So what I decided to do is an iron condor spread, selling the bull put spread at 160 at the low 20 delta, so selling the 160, buying the 155. Selling the 190 bear call spread, so selling the 190, buying the 195, putting them together, so a bear trade and bullish trade together makes it a neutral setup. Here's our trade. So if I position size for maximum, because we don't have to worry about earnings, I'm getting about a 50% return on risk, which is great. And if I put my break evens onto the chart, you can see, they're pretty much bracketed around the point of control, and there's a big volume bill, which can act as a significant center of gravity for the stock. So I'm going to go ahead and right click, confirm and send, and stick that through for tomorrow morning. And there's our trade for today. But that's it for today. You've heard from me now. Now I want to hear from you. You can reply to the tweet down at the bottom of the Market Outlook post, or comment on the Market Outlook post at the bottom of the page as well. Just scroll all the way down to the bottom there. Comment on the YouTube video. If you're watching us on YouTube, comment on Facebook post or the tweet as well, if that's how you got here. But let's hear what your outlook is and what you're thinking and what you got out of the video today. Again, thank you very much for watching. Remember to like, subscribe, and comment on YouTube there. Follow us on Twitter. Follow us on Facebook. Remember, these videos, this is our last week of these videos being free in public on YouTube, as they're going to be unlisted starting on Monday. So make sure that you sign up for our foundation tier so you can continue to get access to these full-length videos. You can see the link for that on the Market Outlook post. There's plenty of links there on the Market Outlook post on our site, as well as in the description of our YouTube channel. You can find a link there. Have a great rest of your Thursday night, everybody. We'll see you all tomorrow.